Hey, hi everyone. Welcome to another video in our options strategies adjustment series. So today we are going to discuss about bull call spread positional trade adjustments in Indian index markets. We will go through specific examples and scenarios from Nifty, Sensex, and Bank Nifty. Okay. We already went through bear call spread, bear put spread, which are directional strategies, and this is a part of the directional strategies. When your view is bullish, then you take a bull call spread. Okay, and this is a positional trade adjustments. So bull call spread, what is it? You buy ATM call, or you could buy an in the money call also. But generally, it's an ATM call with higher premium and lower strike, and then you sell an OTM call to hedge your position with lower premium and higher strike. So that's what a bull call spread is. So you're buying a call as an ATM call, and you're selling an OTM call. So that's a bull call spread, and your view is moderately bullish, expecting index to rise but not skyrocket. Okay, and yeah, advantage is cheaper than buying a naked call, so your reward is defined here, and that's the advantage you get here. And risk reward is max profit is strike difference minus net premium paid, and max loss is net premium paid. Okay, so adjustments, the scenarios we will go through. If market rises quickly, so market is in your favor, you took a bullish view, and the market has risen quickly, so that's uh, that is as per your view basically. So you're in a max profit zone early, and but you have still some time to left expiry. So you could do multiple things when you are in max profit zone early, and you have time to expiry. You can book the profits because you're already in max profit zone. You book the profits and avoid the reversal risk. The second thing you could do is roll up the entire spread. So you close the current spread because you have made profits in it, and because the market has went up, you take an if you're bullish again, you take a spread there, a bull call spread again at a higher. Roll it up further upside. Like if example is Nifty that 20,000, you bought 20,000 C, and 20 you sold at 2,200 C. You close that position, okay, and reopen a buy position at 2,200. You buy a 2,200 C and sell a 2,400 C. That you could do, and on the other hand, you can sell an OTM put also. Okay, so you could convert this bull call spread plus short. You could add a short, sell a OTM put that will become a synthetic long if you're strongly bullish. So you could convert it into a synthetic long if you're strongly bullish also. So second scenario is market rises slowly, so it is going up only, but or it's sideways. Okay, it stays there only. So that's the second scenario. So your call, since you have bought a call, it will have a time decay, right? And short call is will not help to cover that time decay of the bought call, right? So because market is rising, your short call is not helping, right? Short call will help you when market goes down, right? So that's a problem there. And yeah, if the market is sideways, time decay will eat your bought call. So adjustments you could do is you roll down this short call. Okay, so whatever short call you have taken, you bring it closer to the ATM so that you can collect more premium. That's what you could do. Like if Bank Nifty 45,000, it is spot, sell leg from sell leg whatever 45,500 uh, call you have taken, you move it to 45,300. You move it closer to the ATM so that you collect more premium. Okay, or you could do another thing. If market is sideways or rising slowly, then what you could do is you convert this, you sell an OTM put. So basically bull call, and you will add a short put, because this short put, what it will help you is it will get help you to get extra theta because market is rising, right? So you're adding a put and you're selling a put. So that selling a put will add extra theta to your income, and it will protect you against time decay from the bot call. Other thing I could do is close this bot call. So because call is having time decay, theta decay, you close that, and you keep the short call position only. And yeah, if you feel like bearish bias is there, then you could take this. Otherwise, it will become a naked short call, and it's risky. If market falls sharply, so this is against your view. So market went against your view, you were bullish, but market went became bearish basically. So your spread value drops zero, and your time decay also hurts you. So first thing is you close that position and re-enter at a lower position if you're still bullish. or you just close the position, okay, because your view is wrong. So for example, if you want to re-enter, Sensex is at 67,000 and yeah, it dropped to 66,500. Then you close the old spread and buy a new one at 66,500 CE and sell 66,700 CE. That's what you could do. Or you could convert to calendar spread. So if market is falling sharply, then you convert into a calendar spread. So you sell current month call, uh, and you buy next month same strike call to benefit from time decay in near month. Yeah, because you're selling a call and buying the same call. Okay, and this is a calendar spread, a call calendar spread you could do, so that you could benefit because market is falling. You could benefit from the calendar spread from time decay. Okay. Sell an OTM call above current price. That also you could do because market is falling. You could just sell an OTM call, and that call will give you profit, and it will convert that reduce losses. And this is also converted into a call ratio spread also. So basically, once you add a call above the current price, it will convert into a call ratio spread. So that's what you can do when market falls sharply. You close the position, re-enter at a lower strike, or you could convert it into a calendar spread, or you could convert it into a call ratio spread. If market consolidates before even budget RBI Fed events are there, volatility will be low and decay will be high. So adjustments you could do is roll out to next expiry if expecting a breakout later, and close the bot call because call will have decay, high decay there, and you sell a put in. Okay, so that's what you could do. You flip to short volatility strategy. So that's what you need to do when consolidation is there and some event is there where decay is high. You close the bot call and sell a ATM put or roll out to next expiry, so that you can get momentum in the next expiry. Okay. So specific examples I'll go through only one. So Nifty at 20,000, you bought 20,000 CE and you sold at 2,200 CE. Net debit is 70. So if the market is rising, you book the profit and roll up to the 2,200 CE and 2,400 CE. If market is sideways, you roll short call nearer to the ATM. Okay, so push it nearer to the ATM. If market is falling, you close the position and enter it, re-enter it lower strikes. Similar is for Bank Nifty and Sensex also. Same examples. Okay, if it's rising, if it's in a view, book the profits. If it's against your view, you close the position. Okay, if it's sideways, then you move your call leg to the ATM so that you make more, get some theta decay benefit. Okay. So never let a bull call spread expire worthless if you roll down to recover part of the premium. These are the risk management tips. Adjust early when price near short call strike. Don't wait for full expiry risk. Avoid adding too many short legs unless you can handle margin risk. That's it for today, guys. Thanks everyone. Have a nice day. Bye.